Let's be honest, when you hear the word accounting, you probably picture, I don't know, endless spreadsheets and super complicated rules. But what if I told you it's actually one of the most powerful storytelling tools any business has? It's the system that takes all the chaotic, messy, day-to-day transactions and turns them into a clear, compelling story about a company's financial health.
And that brings us to the big question, really. How does any company, whether it's the corner coffee shop or a massive global corporation, make sure the financial story it's telling is, well, true? How do they make it reliable, consistent, and something that investors, managers, and even they themselves can actually trust? The answer, it turns out, is in a pretty elegant and logical process.
And that process is the accounting cycle. The best way to think about it is like the grammar of a language. It's the set of rules and steps that make sure every sentence, or in this case, every financial statement, is built correctly. It ensures the story it tells is coherent and trustworthy. It's the universal playbook for getting from a shoebox full of receipts to a polished professional report. So here it is. This is the entire journey, the whole roadmap on one slide. It's basically a 6-step loop that every single business follows, period. We start by capturing what happened. Then we organize it, we double-check our work, we tell the story through reports, and finally, we hit the reset button to do it all over again. Let's walk through this step by step.
Every great story has to start somewhere, right? And for a business, that starting point is its daily transactions. This is where the raw data, the basic plot points of our financial story, are first captured.
The first step is pretty straightforward. You just have to identify every single event that has a financial impact. A sale, buying supplies, paying a bill. If it involves money, it counts. Then, right away, we move to step 2. We record these events in what's called the general journal. This is literally like the business's daily diary. It captures every financial event in the exact order that it happened.
Now, this slide right here simplifies what might be one of the most confusing ideas in all of accounting: debits and credits. Honestly, the easiest way to remember it is this. For every single transaction, the business gets something, that's a debit, and it gives something, that's a credit. Just think get and give. It's a two-sided coin every single time.
And this example shows that get and give idea perfectly. So let's say a company buys 10 million rupees worth of supplies, but they're going to pay for it later. So what did the business get? It got supplies, so we debit the supplies account. Simple. And what did the business give? Well, it didn't give cash yet, but it gave a promise to pay later. That's a liability. So we credit the accounts payable account. See? Get and give. It works every time. So we've captured all the daily events in our diary. But a diary is just a long, chronological list. It's not very organized. The next phase is all about taking those entries and sorting them into a system that actually tells us something useful. We're about to turn our messy diary into a beautifully organized library.
This brings us to step 3, posting to the ledger. So if the journal was the diary, the ledger is like a collection of books, one book for each specific account. Every cash transaction from our diary gets copied into the cash book. Every sale goes into the sales book. Now, for the first time, we can see all the activity for each account, all grouped together in one place.
Okay, before we go any further, we need to do a quick sanity check. That's step 4, preparing a trial balance. It's a really simple but absolutely crucial step. We just add up all the debits from every single account, and we add up all the credits. And those two totals, they have to be equal. If the sum of everything the business got doesn't equal the sum of everything it gave, we know there's a mistake somewhere in our books, and we've got to go find it. All right, once everything is organized and we know it all balances, we get to the most exciting part of the cycle. This is the climax of our story. This is where all that data we've so carefully collected and sorted gets transformed into a set of reports that finally tell us what actually happened. The first and probably the most famous financial statement is the income statement. This report answers the single biggest question for any business: did we make a profit? It takes all our revenues, subtracts all our expenses over a certain period, and gives us that all-important bottom line. Next up, we've got the balance sheet. Now, if the income statement is like a movie showing the company's performance over a few months, the balance sheet is like a snapshot, a single photograph taken on one specific day. It tells us, at this exact moment, what does the company own? Those are its assets. And what does it owe to others?
those are its liabilities. And whatever is left over, that's the owner's equity. Now, here's a tricky thing. A company can be super profitable on paper, but still run out of money. Sounds crazy, right? That's exactly why the cash flow statement is so vital. It totally ignores things like profit and just tracks one thing. Where did the actual cash come from and where did it go? It tells you the real story of the money. And finally, we have the statement of changes in equity. You can think of this report as the bridge that connects the income statement to the balance sheet. It starts with the owner's stake at the beginning of the period, adds in the profit we made, subtracts any money the owner took out, and shows you exactly how we got to that final equity number you see on the balance sheet. So the story for this period has been told, the reports are finished, but of course, business never really stops. So we need one last critical step to close out this chapter and get everything ready to start writing the next one. And that is step 6, closing the books. What we do is take all our temporary accounts, like revenue and expenses, which only track performance for one period, and we reset them back to 0. Their final balance, which is the profit or loss, gets moved into a permanent account. This totally wipes the slate clean, so the story of the next year can begin from a fresh start. And that brings us perfectly full circle. This whole thing, it's not just some mechanical process of crunching numbers. It's truly transformative. It takes hundreds or thousands or even millions of chaotic individual transactions and methodically turns them into a clear, understandable, and reliable financial story that anybody can read. So the next time you see an earnings report for a company you follow or a headline about their quarterly results, you'll know the incredible journey that data took to get there. The accounting cycle is always running in the background, turning that daily business chaos into financial clarity. The only question left is, what story is it telling?